If you've glanced at your portfolio recently, you've probably felt that sinking feeling in your stomach. The market's taken a serious nosedive, and it feels like every single day is just a sea of red. So let's get into it and figure out what is really driving this sharp correction. You know, the source material really doesn't pull any punches, does it? It calls March a bloody month. And honestly, that's exactly what it's felt like for so many of us. All those hard-earned gains just seeming to vanish into thin air. So is this just random, widespread panic? Or are there some actual fundamental reasons for this downturn? Well, in this explainer, we're going to cut through all that noise and break down the core factors that are really shaking the market right now. Right now, fear is the name of the game. Investors are just glued to their screens, watching the Nifty tumble, and everyone's asking the same questions. Is it going to 22,000, 21,000, even lower? It feels like a classic panic scenario, but there are very specific triggers behind it.
See, it's not just one thing. It's more like a perfect storm of 5 different pressures all hitting the market at the exact same time. We're going to unpack every single one of them so you get a crystal clear picture of what's happening.
All right, so here's our roadmap. We're going to start with those geopolitical tensions that are creating all this uncertainty. Then we'll dive into the direct economic hits, like soaring crude oil prices and a weakening rupee. And finally, we'll look at the big money moves, that is, foreign investors selling off, and what it means that interest rate cuts seem to be off the table for now. Let's start with that first factor, shall we? The first major shockwave is, you guessed it, crude oil. With conflict flaring up in the Middle East and messing with supply chains, prices have blasted past that $100 per barrel mark. And that isn't just a number, it's a direct punch to the gut for both the global and the Indian economy. And this right here shows you the domino effect perfectly. I mean, sectors that are super dependent on oil are just getting hammered. Look at airlines. Their biggest cost is fuel. So you see stocks like SpiceJet plummeting nearly 20%. And it's not just planes. The paint industry, which uses crude oil byproducts, is also feeling the burn. Now this is where it gets really interesting. This slide tells a story about who is doing what in the market. You've got the big foreign institutional investors, the FIIs, pulling their money out like there's no tomorrow. But on the other side, you've got domestic investors, many through their SIPs, who are actually buying this dip. It's a massive tug of war. And just to put that foreign investor sell-off into perspective for you, on a single day, March 13th, they sold off over 10,000 crore rupees worth of Indian stocks. An outflow of cash like that puts immense, and I mean immense, downward pressure on the whole market. And as if that wasn't enough to deal with, we've got 2 more factors piling on. The Indian rupee is getting weaker, hitting a record low against a stronger dollar. At the same time, you have these stubbornly high U.S. bond yields, which is basically a big signal that the U.S. Fed is probably not going to cut interest rates anytime soon. And that just pulls more money away from stock markets everywhere. Okay, so we've diagnosed the immediate problems. But what if I told you that a pattern for this exact kind of downturn might have been laid out in the 19th century? I know, it sounds a little wild, but let's just look at what the source presents here. It's a pretty fascinating question, isn't it? The source we're looking at points to this old historical chart that suggests these big economic booms and busts happen in pretty predictable cycles. So let's see what this thing is all about. And here it is. It's called the Periods When to Make Money chart. It was put together way, way back in 1872, and it claims to map out economic activity into these distinct zones of panic, prosperity, and recovery. So how do you even read this thing? Well, Zone A, that marks the years of panic. Think the dot-com bubble in '99 or the COVID crash in 2019. Then you have Zone B, which points to years of good times, when prices are high and it's probably a good time to sell. And finally, Zone C, that marks the hard times, when prices are low and that's supposedly a good time to buy. Now, according to this chart cycle, we just came out of a panic period around 2019. It actually predicts the next peak, or good time to sell, will be around 2026. And that's supposed to be followed by a period of hard times, which it calls the best time to accumulate, from 2026 all the way to 2032. So, if we take this historical view, what does it actually mean for your money right now? Well, the source suggests a pretty clear strategy for how to navigate a period of volatility like this one. This perspective leads directly to a game plan, and the core advice? It's pretty straightforward. Don't panic. Keep up with your systematic investments.
Remember, a falling market just means your money buys you more units of a stock or a mutual fund. The real key here is to stay disciplined and, of course, make sure your assets are well diversified.
I love this quote from the source. It just captures the entire philosophy perfectly. These moments of market panic, these red days, they're not presented as some kind of disaster. Instead, they're framed as the very opportunity that leads to future gains, to the green days.
All right, so after all this turmoil, where does the market go from here? Well, the source makes a very bold long-term prediction that really puts this current downturn into a much, much wider context. Yep, you're seeing that right. The long-term forecast being presented is that the Nifty will eventually hit 32,000. It's a powerful reminder that despite all the short-term panics and crashes, the long-term direction of the market has historically always been up. And that right there is the ultimate takeaway. The source isn't just predicting a number, it's really posing a question to every single investor. Look, market downs are scary, no doubt about it, but they're also a test of your strategy and your patience. History suggests a recovery will come. The real question is, will you have stayed the course to be a part of it?